Today, folks, so we got four stocks we need to talk about when it comes to earnings and just how drastically important these are to what's going on in the economy. We're going to talk about one Canadian dividend stock I really want to buy and why I think it's a potential buying opportunity. Of course, we're talking about TELUS, the telecommunication giant that posted earnings, and the stock dropped again even after it posted. We'll talk a little bit about Enbridge, that massive pipeline company spanning North America here in Canada and the US. And then, of course, the two mega giants. We should start off with Apple and Amazon because, I mean, it's Apple and Amazon. If that's a conversation you'd appreciate, hit that like button because we're going to continue this conversation later tonight, every Friday 9 p.m. Join my live streams. Consider subscribing for that as well because there's so many other details that I'm just going to leave out of this video that I don't have time for. But Apple, guys, take a look at this, man. Apple, I think it deserves to drop. It has been running. Any stock that ran well beyond its all-time highs over the last several months deserves to take a bit of a healthier pullback, and that's what we're starting to see here. And I think it's leading into a buying opportunity. Apple, I think it got overextended, and I'm happy it's pulling back because it's just one of those stocks that even Warren Buffett's going to pick up on the dips. It's just, again, it's not growing. It's not picking up like Google is or Amazon and some of these stocks we talked about. But the fact is their profit, their cash flow is still exuberated, and it just shows that people aren't flipping into these products like they used to be because, again, we're in a higher interest rate environment. Cash might be a little tighter. Total net sales sitting at $81.7 billion versus $82.9 billion this time last year. Their total 9-month ending has declined slightly, and this is people saying, hey, it's the end of Apple. Apple is showing 3 or 4 quarters of negative growth like it was in the dot-com era. But I don't think that's a negative because we're not talking about massive declines by any metric. Gross margins are actually higher than where they were this time last year on the quarter, which means they've probably done a little bit of cost cutting. But nonetheless, again, just you look at the products here. You zoom in, just take a look. iPhones, no. And people aren't flipping out their iPhones like they were, obviously. Macs, way too expensive. iPads, people are probably oversaturated with those. Wearables, still seeing a little growth quarter over quarter because, again, who's not buying a wearable these days? A little cheaper as well. Services, obviously, like cloud, Google, Microsoft, we'll see it with Amazon as well. Cloud is the primary driver of the future, not product sales themselves. But with all that free cash flow, Apple could buy businesses left, right, and center. Obviously, we're talking about their VR coming out at the beginning of next year, which I'm curious to how it competes with Meta's Quest 3 that I'll personally be buying. But talking about the consumer and the economy outside of Apple products, Amazon is proving that there is still a lot of consumer demand out there. Even though there was some hiccups coming into the beginning of the year, I think Amazon still has some room to run, and it has been one of the best performers since earnings have kind of posted here. And take a look, no surprise, net product sales went from $56 billion to $59 billion on the 6-month end. 116 billion versus 113. I mean, total net sales went up pretty dramatically here. They just absolutely crushed. And it's nice to see almost all their segments are growing. But again, you take a look at AWS here. Their cloud services, their operating income actually declined to 5.3 billion versus 5.7. Yet their net sales actually increased by almost $2 or $3 billion. So there's some operating expenses as they're probably putting more capital into this, maybe building more centers, something that you're going to want to dive down into. But take a look at North America net sales just in general. I mean, North America is just plowing income into Amazon. We bought a property. We're ordering so much stuff on Amazon. It shows up the next day. It's so damn convenient. It's nice to see that Amazon's getting a little bit of light here because it's probably well deserved. Now, on the Canadian side of the economy, I got to talk about TELUS. I want to buy this stock. It's been on my buy list. It's dumping up a little bit after it dumped after earnings, but nonetheless paying a 6.3% yield. I think this thing is now at a point of potential real good buying opportunities here. This one is deserved to drop for specific reasons related to interest we'll look at, but the fact is you just take a look at their signups. Total consumer growth just for this quarter, guys, 293,000, up 46,000 over last year, a second quarter record driven by healthy demand for our leading portfolio across mobility and fixed networks. They didn't even revise a lot of their, basically their growth rates here. If I scroll down, I think they're targeting consolidated operated revenue for 2023 of 9.5 to 11.5%. They're in a very great spot. Their free cash flow guidance for 2023 is approximately $1.5 billion to reflect significantly higher restructuring costs related to accelerated cost efficiency programs implemented to drive EBITDA expansion. I do think they mentioned some stuff on the dividend here, and we definitely can't discount the dividend here of 0.3636 cents, an increase of 7.4% over the same time period last year, and yielding about 6% obviously as looked, which is why I want to buy it, because this is the dividend safe. That's what everyone's kind of asking themselves, because what they do is they go onto Yahoo like a bunch of Yahoo idiots. They go statistics, they scroll down and oh my god guys, the payout ratio is 135%, they're going to cut the dividend even though they just increased it. But can they actually afford that dividend? That's the question we have to ask ourselves here. Now, one of the biggest expenses that's kind of deriving a lot of the fear as well is the 64% increase in interest expense, and yeah, that's going to be painful. Some of my bull thesis, I'm predicting that over the next year or two they're going to start cutting interest rates back to a nominal 3 to 4% as soon as inflation kind of realizes out. If inflation goes back up dramatically, that could be a fear that interest rates go higher, and that could inflict further. So there's some speculative risk with this, but can they afford the dividend as it stands today? Adjusted net income of $273 million does not justly cover the dividend of 36 cents. Basically, I think this is just for the quarter, right? So the fear with this is that if you times that by the shares outstanding, it's about 550 million, I think, give or take. So they don't look like they have enough to cover the dividend, but that's not actually true. If you take a look here with the depreciation and amortization of intangible assets, the only way I can explain this to a layman is imagine you buy a car, you pay 30 grand for it, boom. You immediately lose 30 grand on the value. Now you're using that car for Uber, or you're using it to make money to get to your job. The cool thing is for businesses, that car is going to lose value. It's not an appreciating asset. Over time, that car will lose value. Even though it keeps generating the same cash flow, it's going to lose the value, the resale value. But you can write every single year that resale value off against your cash flow. So that can actually deter you from posting that extra cash flow, because then you don't have to pay tax. You can say, hey, I lost it in the value of this vehicle this year. So it's an easy way of explaining it. You can see the depreciation increased 62 million for the second quarter and 151 million in the first 6 months of 2023, primarily due to growth in capital assets, because they've been investing right over the past 12 months, including business acquisition and our expanded broadband footprint. Amortizations increased 113 million in the second quarter, 204 million in the first 6 months, arising from business acquisition and higher expenditures. So the reality is this depreciation here would be enough to completely cover their dividend for the quarter. So that's what you have to understand, is this is not a loss. It's already spent capital, and it's like that vehicle. It's generating the same cash flow, but they're writing the lost value. So it's a way to save tax. I hope I explained that in a simplified manner, and the dividend is still coverable from that aspect. Doesn't mean it's not going to be cut in the future. Doesn't mean there's not going to be issues. They're laying people off like crazy, obviously. Bell is, a lot of these telecom giants, because they're heavy infrastructure debted companies. But I still think it's at a value play at this point. Kind of talking about infrastructure, Enbridge. We can't not mention Enbridge here. This one's pulled back pretty dramatically, kind of follows in line with what the oil prices are doing, and oil has pulled back since the peak, I think, of 2020, 2022 period here. But nonetheless, with the 7.39% yield, I haven't dug as deep into the expenditures on this guy, but it's growing fantastically. Look at the adjusted EBITDA at 8.4 billion versus 7.86 billion this time last year. Almost most of their segments, especially the liquid pipelines, which matter a lot, have been growing. Energy services declined a little bit here, but renewables went up slightly. Gas and distribution went down quite a little bit. The vast aspect of their business being pipelines is growing at a very nice, healthy clip here. And you can honestly see the distributed cash flow was about, 2.7 billion of the adjusted EBITDA there. So they're in a pretty healthy position as far as I can tell. Again, I haven't dug deep enough into it to, really get a full grasp on it, because I understand cell phone providers easier. And I really want to discuss some of the issues with the Canadian economy, because this is all driven by the exponential growth, the explosion in immigration that's happened, but there's issues with that, and we'll discuss a little bit more of that on my live stream later tonight, along with some really cool ideas behind stocks that you probably shouldn't buy as pump and dumps, and a few more things in between. So if that's a conversation you appreciate, subscribe for those updates. Let me know what you think in that comment section below. Stay cool, stay awesome, and as always, I'll catch you in the next one.